Hello, and welcome to the first in a series of video podcasts. I'm Rachel Souza, and I'm a tax partner at RSM, based in our London office, but more recently, of course, simply based at home. Each week, myself and my fellow partner, Andrew Robbins, will tackle a particular tax subject which is relevant to the private client industry. We have plenty of ideas already as to what we're going to cover, but please do email in with your suggestions and or any feedback you have about the podcasts going forward, because we would be very happy to take any comments on board. We can be contacted on our usual email addresses, which are rachel.d'souza@rsmuk.com or andrew.robbins@rsmuk.com. We hope you enjoy, and we look forward to sharing our thoughts with you over the coming weeks.
Let's talk a bit about wealth taxes, actually, because there's been inevitably a lot of talk about how is the government going to raise all the money that it needs to raise after the huge amounts that are being pumped into the economy. And one thing that I've been hearing a lot recently is speculation about the introduction of a wealth tax. Because on the face of it, it does look quite an attractive approach for government to take in terms of politics and in terms of ease of raising money as well. And certainly on the political side, I don't know what you think, Rachel, but it feels to me like if you had a wealth tax that, I don't know, let's say it only impacts people whose wealth is more than £1.5 million, from a voter perspective, the majority of the population will not actually be paying it.
Yeah.
The people who are, if I was being very cynical about this, I would say that the majority of the people who are paying it are probably going to be seen by the government as being most likely either well-established conservative voters or beyond the pale, and they're never going to vote conservative anyway. So the political fallout in loss of votes might be relatively small.
But I think it plays, and it also plays to the point that those with the broadest shoulders should be paying or helping to pay for this expenditure that we've had, and certainly the youngsters who seem to be disproportionately hit from the pandemic won't be hit at all with this type of a tax.
So if you were going to impose a wealth tax, Rachel, what would you do? How would you impose it?
Well, I think the first thing we've got to think about is, what assets would actually be included within the calculation. It could range from literally all of somebody's assets, so their house, their car, their jewellery, their paintings, or it could be done on some more limited basis. But I think for ease of concept, the idea must be that you include all of your assets and you do a little annual personal balance sheet.
And I guess we've seen, whether you do this annually or not, we've seen something a little bit similar with the ATED regime, where for residential property owned in a company, we have for some years now had this system where there is effectively what equates to a wealth tax, in that if the value of the property is more than £500,000, there is an annual fixed tax charge, which in the ATED case it's a series of layers. You get the property valued once every 5 years, and then for the next 5 years you pay an annual fee based on that value. And so maybe rather than having to revalue all my assets every year, we could do it in a slab basis that way.
Yeah.
The big problem, the big issue that I see with any form of wealth tax that's going to be broadly based is the practical one, though. I do wonder how you're actually going to be able to value all of your assets. If we do include everything down to, including my car and my personal artwork hung on the wall and the shares that I've got in the family company, somebody's going to have to value that.
Yeah.
And not only am I going to have to value it to put it on my personal balance sheet, but the revenue are then going to need to check it. And it seems to me like that's going to create an enormous amount of work. You're going to need
maybe this is a good point then. We're going to need more valuers, more surveyors, more thing. It's a way of giving more employment to a wider range of people. So you get a double hit. You get a
further job creation.
But more seriously, the other point that strikes me about a wealth tax is whether liabilities should be deducted. So if you've got a mortgage on your property, is that actually a deductible expense for wealth tax purposes? And I think in some countries which have a wealth tax, they allow a deduction, and in others, they don't. So, there's no right or wrong way of determining it. It's just however the tax is formulated to start with.
It would be a very interesting moral element to a wealth tax, wouldn't it? Depending on, do you think that borrowing is good or that borrowing is bad? And you feed that into the basis that you charge your tax, so that if you're highly leveraged, you get punished by having a wealth tax on your gross assets.
That would be interesting, wouldn't it? I mean, I think this is a subject that's going to run and run, and perhaps it's something that we'll return to in a later episode. But for now, we would be interested if people have got thoughts or they want to make a comment. And you can contact us at our usual email addresses, which we'll provide at the end, if you do want to make any comments on the subjects that we discuss. Now, before we end, we're going to end on a lighter note. And I'm going to pass over to Andrew for some thoughts on something that he could share with you that's a little bit lighter than our tax talk.
I just wanted on this particular one to heavily recommend a podcast. Rachel, as you know, I'm a big podcast fan of a very wide range of things I like to listen to. But the one I wanted to flag today, it sounds a bit boring, but in fact, it's just fantastic. It's a podcast called Cautionary Tales by Tim Harford. Tim Harford, if you listen to Radio 4 at all, he fronts More or Less, which is the radio show about statistics. He's a journalist with the Financial Times. He's an economist. And Cautionary Tales is what it says on the tin. It's a series of talks about historic disasters, things that have gone wrong and why they've gone wrong. And it's absolutely fascinating. Talking about psychology, economics, sociology. Why is it that something can go that seems so obvious? Why does everybody miss it? The analysis of how the human brain works, why do we think the way we do, is really interesting, and Cautionary Tales, highly recommended.
Brilliant. And I have to say, Andrew often gives me recommendations for podcasts or other things, and the last one he gave me was absolutely fantastic. So I shall certainly be taking a look at the Cautionary Tales as well. As I mentioned, you can contact us with any comments you've got, and that's at our usual email addresses, which is rachel.d'souza@rsmuk.com or andrew.robbins@rsmuk.com. And we hope to see you again next time. Bye for now.
Bye.